Hello, scholars. My name is Joseph Ejike Oj. The topic of this lecture is efficient market hypothesis. Now, as those of you in finance and accounting, general business, I'm sure you must have heard of this theory about efficient market hypothesis. Well, what efficient market hypothesis is saying is this. Well, as you know, it is an investment theory. So what it is saying is that it is impossible to beat the market because market efficiency causes the share prices always incorporate and reflect all relevant information. So what he's saying here that investors, fund managers, even mutual funds cannot beat the market. When I say beat market, I mean having the same return. Getting more return than market return. What are those markets I'm talking about? They include market like S&P 500 futures, Dow Jones Industrial Average. S&P 500 market tracks the stock. It tracks the stock of largest 500 corporations, US. We also have the market for technology stocks, which is the NASDAQ. Then we have market for manufacturing industries like Dow Jones Industrial Average. These are the markets we're talking about. So the efficient market hypothesis is saying that it is impossible for investors or fund managers it is not possible for their returns to be bigger than the return of market indexes, which means that they cannot beat the market. That is the simplest way of explaining that. So according to the efficient market hypothesis, markets are efficient. Therefore, because they are efficient, they leave no room to make excess profit by investing in stocks, because everything is already fairly and accurately priced in to the stock price. So which means that there is a little hope of beating the market, although you can match the return of the market, but you cannot beat the market. That means your return cannot be bigger than the return of the market. So, so as you can see, the main theme of the efficient market hypothesis is that no investor, no fund manager, or any other players in the market, none of them can outperform the overall market through expert stock selection or market timing. So that means that the only way the investor, the fund manager, or other players in the market, other key players in the market, the only way they can possibly obtain a higher return than the market is by buying riskier investments. So what is saying that everything about the stock, look at let me show it, saying it by showing you. Let me use the stock of Visa. We all know Visa, or is a credit card company. So this stocks as of last week was trading at $230, $230.13 per share. So you see that this price of this stock and this price, whether it is go up or down, everything about the market has already, whether it is a new announcement by the Federal Reserve or any other thing that will add value, any information that will add value about this market, information about merger and acquisition, job report, purchasing power of the consumers or consumer sentiment, anything about it that will add value have already been factored in this price. It is those things that made this to be made Visa to be sold at or to trade at $230.13 per dollar. So there's nothing, no other information you get that make you to predict that it will rise above this price and then make extra money than what the market is saying. See? So that means that according to this hypothesis, the, the current stock price reflects all existing available information. So this makes them to be fairly valued as they are presently. So with this, it implies that at performing the market, the possibility of an investor, a fund manager, or another player in the market, the chance of them outperforming the market through stock picking or market timing is highly unlikely, unless they are maybe lucky, just lucky, or very lucky, or that they are not very lucky. So now this theory was one of the people that developed this theory is a very renowned finance and economist, finance specialist and an economist too. His name is Eugene Fama. He used to be a professor at the University of Chicago, and he's also a Nobel Prize winner. Now, Professor Eugene Fama is also regarded as one of the, basically as the father of finance. So, now we can now look at the variants of the efficient market hypothesis. There are three variants. First one is the weak form efficient market hypothesis. According to the weak form efficient market hypothesis, according to this weak form, prices are of untraded assets. Right, that means prices, like when they say assets, they mean stocks, bonds, and other things that are sold in exchanges. So according to this weak form, prices on traded assets already reflect past publicly available information. That is, the price have already reflected information that investors can take advantage of to make decisions to buy and sell. So those things are already added on the price. So the price cannot move in any other direction that will create an advantage or create value for the investors, because everybody knows about it, So nobody will make money since everybody knows about it. So because of that, the rate of return on the market is independent, and past return have no effect on future return. So, in other words, traders who especially those that use technical analysis to determine the direction that the stock price will move, all those things are invalid according to this weak form efficient market hypothesis. Okay, because the past do not influence the future prices. So, technical analysis of any form is a fruitless endeavor. So that means those chartists who like day traders and weekly traders cannot all the analysis they make based on their charts using a different kind of charts. All those things are invalid according to the weak form efficient market hypothesis. However, people like talented fundamental analysts might be able to benefit or make extra value by using some tools of fundamental analysis like ratio analysis to make make a little bit more returns or make good returns. A return that is very, very close to that of the market. Yeah. Based on their ability to predict what the information that might influence prices. So this, according to this weak form, technical analysis is invalid. Fundamental analysis is a more valid way to know where the value of the stock will be, or what direction the stock will be moving. Okay. Now, the semi-strong efficient market hypothesis, it is saying the same thing that weak efficient market hypothesis is saying, except that it also assumes that even when there's a new information, that information is instantly priced into the stock market. So that means the stock immediately, that new information that is released will become immediately priced into the market, stock price. So the stock price will react immediately to factor in that information. That means, suppose the example I gave you with a Visa. For example, suppose that this is Visa is a credit card. Okay. Suppose that there's a release of unemployment reports, and there's a lot of people are getting the job report is released, and many people are getting jobs, and also the consumer sentiment report is released, and people are more confident, and they are buying more things. That might cause the price of Visa to go up. So this information, job report and consumer sentiment, when they're released and they are both positive, you see this Visa price, the price of this Visa go up immediately. So by the time an investor decide to buy this stock at $230.13, and then wait for the price to go up so he can make money or she can make money, the price have already been factored in or priced in or reflected. So there's no time enough for you to make that money. That is what the semi-strong efficient market hypothesis is saying. So you say that when there's a new information, it is instantly priced into the market, which means that even the fundamental analyst or technical analyst cannot generate excess return. Okay, so now that means they can't beat the market. Next is the strong form of efficient market hypothesis. Now, sometimes investors can make big money if they have insider information. For example, if an investor knows that somebody working at Walmart, the management of Walmart, people who are like my big CEO and the board, suppose that he overheard that Walmart is planning to buy dollar stock. So with this, and they want to buy it in 1 week. The deal will be completed in a week's time. This kind of information can cause the price of dollar stock to jump in a week's time. So if that person knows about this, and then call a friend and tell a friend, go and buy dollar stock, go and buy the stocks of dollars, dollar tree, I need to say dollar tree, not dollar stock, dollar tree. So suppose Walmart, you have that Walmart is about to acquire dollar tree, and that deal will be completed next week, which will cause the stock of dollar tree to jump. Now that guy, if that guy is call a friend, go and buy the stock of dollar tree, buy all you can get, because you're gonna rise. That is insider information, and that will be illegal. Somebody can go to jail for that if it is proved beyond reasonable doubt. Now, suppose this strong form of efficient market hypothesis is saying that even if there is insider information, okay, price instantly reflect those information. Market prices instantly reflect that hidden insider information as well, so that by the time your friend will want to buy the stocks of dollar tree, the price has already risen, so that they will make much money on it. So even whether it is past information, present information, or insider information, the strong form of efficient market hypothesis is saying that it is still not possible for you to beat the market. So, in other words, the strong form of efficient market hypothesis, those who follow it believe that all information, both public and private, is incorporated into a security's current price. In other words, not even insider information can give investors an opportunity for excess return. So that, in other words, no investor will be able to profit above the average investor, even if he has insider information. So now, the most important thing to know is that although we regard efficient market hypothesis as the cornerstone of modern financial theory, some people it is highly controversial, and people, some people believe it, some people don't believe it. Those that believe it argue that it is pointless to search for undervalued or stock, or to try to predict the trend of the market through either fundamental analysis or technical analysis. Yeah. So at this point, we are ready to look at the arguments in favor of efficient market hypothesis and against it. Like I said, not everyone believes in an efficient market hypothesis. Not everybody, some believe it, some don't believe it. So many active portfolio managers believe that they can leverage their individual skills and experience, and they can use it to exploit the market's inefficiencies and generate good return that may be bigger than the market return. But most academics point to a large body of evidence in support of efficient market hypothesis. So the bottom line here is that there's evidence to support both sides of the argument. So both those who support efficient market hypothesis and those who doesn't support it, both of them are correct. But there's argument on both sides, that support it. Let's look at the case against it. The first one. As we make use of the data from Morningstar active and passive barometer reports. It's called the Morningstar Active and Passive Barometer Report. According to this report, this report is published twice every year, and usually it measures the performance of active managers against passive managers. Nearly the one they have in 2020 they analyzed almost 3,500 mutual funds and came out with this result. According to their results, about 49% of actively managed funds have outperformed. They made more return than passively managed funds. That means those that believe that they can beat the market by their skills in picking stocks, and they are called the active managers. Those who does not believe that I'm just buying index fund are the passive managers. So according to this Morningstar Active and versus Passive Manager Barometer, their results of the analysis in 2020 is that 49% of the actively managed funds outperform the passively managed funds. So a report also showed that active managers of US real estate funds outperformed the passive managers of USA's real estate funds. So what they're saying here is that actively managed fund performed better than passively managed fund in that year. Now, another one is the argument we can use here is based on what happened in the stock market in 1987. So where in 1987 stock market crash, the Dow Jones Industrial Average, which is a market index, fell below 20% in a single day. So this is a good example that stock prices seriously can deviate from their fair values, which is not what the efficient market hypothesis is saying. Okay. Another one is this. In April of 2020, we have the oil price dropped to negative value. You can see it from this graph here. You can see it from this graph. it dropped below zero, wasn't even negative. See, nobody saw it coming. Even you see, so this is also a good example. It goes against what the efficient market hypothesis is saying. Now, another argument, those who are against efficient market hypothesis, that hypothesis is saying that nobody can beat the market. There are some investors like Warren Buffett, Peter Lynch, and John Templeton. These investors have consistently beaten the market over a long period of time, which is by definition impossible. I mean, according to efficient market hypothesis, this is impossible. But these investors have actually done it for years. Okay. So this is all this things I listed argument against efficient market hypothesis. Now let's look at the argument in favor of that. So according to the efficient market hypothesis, remember, according to the efficient market hypothesis, the performance of investment analysts and mutual funds. Okay. Sorry. According to the efficient market hypothesis, you can't beat the market. Yes. But and there's evidence to that. The one I gave you example, the Morning Star Active Passive Barometer Report. Well, the Morningstar Passive and the Morningstar Active versus Passive Barometer Report may be correct that 49% of actively managed fund outperformed their passively managed fund. But when you add when you look at the performance over 10 years, this is performance of the actively managed fund. This is the performance of the passively managed fund. When you look at the performance over 10 years period, ending in 2020, you will see that a different picture. You will see that the percentage of active managers who outperformed comparable passive managers dropped to 23%. After we add the fees, because all these active managers, they charge you fees to manage your fund. So when you add those fees that they charge, you see that the performance of both actively managed funds and passively managed funds, like index fund, are basically almost the same. So which is a good way, which is what the efficient market hypothesis is saying. You can't beat the market. Another one is this. The US real estate fund may have outperformed passively managed vehicles 62% of the time. But when you add the fees those actively managed funds charge, and not only that, the transaction fees, each time they buy and sell, you pay transaction fees. You see that they're basically the same. So they didn't beat the market. And you know that passively managed funds basically track the market. So whatever the market is what they are. And passively managed funds, actively managed funds doesn't track the market. The managers try to beat the market. So if their performances if the performance of the actively managed fund is the same as the passively managed fund, that means performance is the same that means that the performance is the same as the market performance. So they didn't beat the market per se. So that's what they're saying. So in other words, the additional fees for portfolios that are actively managed tend to drag on their overall performance. So all these things that I just explained is the reason why investors who follow efficient market hypothesis always prefer to buy index funds like Fidelity, Zero Large Cap Index here, and then exchange traded funds like e.g. Vanguard S&P 500 ETFs. So now let's look at efficient market hypothesis in retrospect. So the truth is that some markets are more efficient or less efficient, while some are more efficient. Let's look at the inefficient market, the one that are mostly inefficient, like the market in developing countries of Africa and Asia and South America. Those markets can be, inefficient. Why? In those markets, we call them the emerging markets. So in those emerging markets, liquidity and transparency can be limited. Also, political and economic uncertainties, legal complexities, and lack of investor protection are more common in those markets. I'm talking about most African markets, Asian markets, and South American markets. So all these factors that are present in their market can create considerable inefficiency that investors can exploit and make more money, beat the markets. So, but some markets are very efficient, like the US market, and the Western European markets. So the US market for large cap and mid-cap stocks are heavily traded, for example, and the information is rapidly incorporated into the stock prices. So in this kind of market, when I say the market, I mean this advanced market, I mean the US market and the Western European markets. So in this kind of market, efficiency is very high, as can be, you can see from a Morningstar result, or even a Wall Street Journal, or business news, the business channel like CNBC. So, the bottom line is this: the market often misprices securities, as we can see, even in an efficient market. Markets sometimes misprice securities, as we can see in the stock market crash of the 80s and the oil market crash in 2020. So the market often misprices security, at least in the short run, but investor cannot know beforehand when mispricing will occur. So I believe you enjoyed my lecture. And the next one, I'm going to be looking at how to value stocks and corporation. Thank you for listening, and I see you in my next lecture. Thank you. Bye-bye.